In order to discuss historical returns, we need to take a look and define what returns are. So let's look at the following example. Suppose you buy a stock that's selling for $37 a share, and you buy 100 shares of the stock. And let's also assume that you receive a dividend of $1.85 per share. Then the cash outflow is going to be the following, okay, or let's say the dollar outflow will be equal to $37 times 100 shares, which is going to equal $3,700. So using this time cash flow diagram we've used in the past, let's put in $3,700, or actually minus $3,700 as our cash outflow. Now, let's also consider the case where you're getting a dividend 1 year from now. So your dividends are going to be equal to the $1.85 times the 100 shares, or you're going to get $185 in dividends. All right, let's also assume that the price of the stock in year one, so this is the price of the stock, let me put a subscript in here, PS0, and the price of the stock in year one is $40.33. So let's see what we have here. When you sell the stock, okay, what's your outflow going to be? Your outflow, or I'm sorry, your inflow, the money you would receive when you sell the stock, so your dollar inflow is going to be equal to the dividends plus the dollars received from the sale of the stock. And how much do you receive? I don't think I need to multiply that out for you. $40.33 times 100, so that's going to be what? $4,033. So let's see what our dollar inflow will be. Our dollar inflow is going to be $185 plus $4,033. All right, so we can add those up. Let's see here, 4033 plus 185, and we get $4,218. Now, there's a couple of ways to look at what we received. Sometimes we like to look at something referred to as capital gains. We already did the dividends. We also have something referred to as capital gains. Capital gains represent the amount of money that we make from selling the stock at a price that exceeds the price we paid for it, times the number of shares we had. So in this case, we sell the stock for $40.33. We paid $37 for it, times 100, and we're going to receive a capital gain of $333. Okay, if you work this out, it's $3.33 is the capital gain per share times 100. You have a $333 capital gain. Let me go back to my time cash flow diagram. So what did we say we had? We said our cash outflow is $4,218, and you could divide this up, right? So the first part of it could be the $4,033 that you receive from selling, and then this last portion up here could be the $1.85 or $185 you receive in dividends. Okay, so we're going to use this information to calculate rates of return. What we've calculated here are dollar returns. Okay, you have a dollar return of $185 in dividends. You have a $333 capital gain. So if you added those two together, that would be your dollar gain. You could also have a capital loss. If the price of the stock went down, okay, in the textbook they do an example of $34.78, and you would have a $222 capital loss. All right. Distinguishing between capital gains and dividends is important in large part because the U.S. tax system treats capital gains and dividends differently. Okay, it treats the income you receive differently. If you've been following some of the political debate, there's been a lot of argument that people like Mitt Romney, who are quite well-to-do and have a lot of money invested, Warren Buffett as well, pay a very low tax rate because much of their gains come from capital gains. The fact that the securities they purchased went up in value. And right now, as I'm making this tutorial, the capital gains tax rate is 15%, which is very, very low. So if you make most of your money from capital gains, okay, you're going to pay a low tax rate. So, there's arguments about that. That's not the point of this tutorial. We want to sort of understand how we do some of these returns here. Okay, well, let's see what we have here. Okay, well, we have the case where let's see. Well, let me put down the dollar return. Okay, so our dollar return is going to be equal to the $185 in dividends plus the $333 we received in capital gains. So it's $518. Okay, but that doesn't tell us very much. It doesn't tell us very much because you made $518, but how much money did you have to invest? That's why we like looking at percentage returns. Okay, you make $518 on a $1 billion investment. That's not very good. You make $518 on a $10 investment. That's phenomenal. So it's better to figure out what our percentage rate of return is. And percentage rates of return look at the return you receive on the amount that you invested. So let's take a look at some different percentage returns. Okay, we can break up the percentage returns into different components, just like we broke up the returns here into dividends and capital gains. We can also break this up into dividend yield, and dividend yield is the percentage return on the dividends. And dividend yield is defined as the dividend that you receive next year divided by the price you paid. Okay. In fact, I can give you a more general notation. Okay, PT, and we'll call this T plus 1. Okay, what's the idea here? We're talking about the dividend you receive 1 year into the future divided by the price you now. So this could be year 0 and year 1. This could be the price you paid in year 1 and the dividend you received in year 2, etc. So if we go to the example we had, we could look at the full dollar amount, but we can just do it per share because your return per share is going to be the same as your return for the total amount you invested. So we know you receive $1.85 per share in dividends. You paid $37 per share for the stock. So let's see what our dividend yield or our percentage return on our dividends is. So $1.85 divided by 37, and we get 0.05. We get 5%. keep in mind you're not always going to get such a round number, and I've mentioned several times you need to set for enough decimal places. When you don't see any decimal places after the 0, this is floating. That means I get all the decimal places. If you only set it for 2 decimal places, there may be times when you get 5.25%, it just rounds it off to 5, and that's not really correct. So make sure you set your calculator for at least 4 decimal places, and you can do that by going second, format, it says decimal. I have 9, that gives you floating, but you could set it for 4. You have to hit enter, and then you'll notice that it always shows 4 decimal places. Okay, I much prefer floating. I can then go around and just do the adjustment myself. Okay, do the rounding off myself. Okay, the other return you get is something referred to as capital gains yield. Okay, our capital gains yield is going to be equal to the price you get 1 year in the future, what you receive, minus the price you paid, okay, currently, okay, or one period before you sell the stock, divided by the price in period T. So again, we can just do this using the prices we paid for it. So we said, what, $40.33 minus 37 divided by 37, and we're going to get 0.09, I believe. Let me see there. 40, I'm sort of cheating here. 40.33 minus 37. Okay, this is the capital gains amount, 333 divided by 37, and we get 0.09, which is 9%. Okay, so I could also write, sort of ran out of space here, I'll just write 9%. All right, what's our total return? Our total return is the sum of the capital gains yield and the dividend yield. So our total return here is going to be equal to the dividend yield plus the capital gains yield. And in this case, it's going to be 5% plus 9%, which is going to be equal to 14%. Okay, we could do that using our total numbers here. Okay, just to see that we got the same thing. It's easier just to work with smaller numbers, but we could do this. We could use our financial calculator, which you should be familiar with now. We could put in number of periods. Well, let's clear the time value of money worksheet first. Remember, second, clear TVM. N is 1. We don't know what the interest rate is. That's what we're trying to compute. 3,700. Okay, make that negative because it's an outflow, is our present value. 4218 is our future value, and let's compute the interest rate, and we get 14%. Okay, so you can do it with the full cash flows using the dollars received, or you can just look at how much the price has changed and how much your dividend yield was, and you're able to calculate this percentage return. Percentage return makes a lot more sense because the person who owns 1,000 shares of stock is going to have a much bigger dollar return than a person who only owns 10 shares of stock. But their percentage return is the same. So keep that in mind when you're looking at these charts. They're showing percentage returns, they're not showing dollar returns.